Hey everybody, so in this video we're going to cover some technicals. Now just want to make a quick announcement. So in the future if I make a video, it's going to be most likely going to be one of three things. So I'm either going to point out some change in the technicals that I noticed, or I'm going to talk about company earnings, or I'm going to be talking about just tutorials or whatever. So how to do certain things, XYZ. So in this video we're going to go over technicals because I definitely noticed some serious changes that happened today. So let's just go over this real quick. So looking at Apple, I'm just looking at these moving averages right here. This pink line is the 200-day moving average. This orange line is the 50-day moving average. So today we saw a clear break of that 200-day moving average. We closed below it. So the 200-day moving average is at 147.20. We closed at 146.71. Pay attention to these two candles that we had prior. So we had this doji candle and then we had this hammer candle. So this doji was basically saying, hey, you know what, indecision, do I want to break underneath this or do I want to stay above it? And then end of the day, we tested it intraday. We tested that 200-day moving average intraday, but we managed to close above it. And then same thing with the day prior. We tested that 200-day moving average. We closed above it. We had a strong reaction to the upside. It seemed bullish. Then you got the PCE report this morning, and guess what happened? We cracked underneath. End of the day, we did try to rally, but we didn't quite close above the 200-day moving average. Now, keep in mind, we have this 50-day moving average, which is this orange line. It is at 140.56. So it's very possible in the near future that we just trade within this range between these two moving averages. And obviously, if we break below this 50-day moving average, things get much more bearish. Moving on, let's go ahead and look at Microsoft. Microsoft is very, very interesting because obviously we saw all of this AI hype, but then we clearly saw that this move was faded. We see several gaps in the chart. So now look what happened right here, these last few trading days. So these last three trading days, the day prior to today, we pretty much tried to crack underneath the 200-day moving average. And you can see the day prior, we had a strong bounce off of the bottoms. Now, if you look right here, this basically was around 150, and then we ended up closing that day around 255. So it was a pretty strong bounce. Now, look what happened the day after. After that PCE, we got wrecked. Now we're underneath that 200-day moving average, which is at 252.88, and we are above the 50-day moving average at 246.88. So it's very possible that we could just trade within this range between these two moving averages. Now, the key thing to note is that if we break this 50-day moving average, there is a lot of potential downside. So definitely something to watch out for. Now, let's go ahead and look at SPY. So SPY is also a pretty interesting situation. So recently, we had this golden cross, where we had the 50-day crossing over the 200-day. And now we can see that this 50-day moving average is starting to flatten out. We can see that this 200-day moving average is also starting to flatten out as well. So obviously, if we see price action continue to fall, this 50-day moving average, it can end up curling down. And then this 200-day moving average could end up flattening out. And then what we could end up with maybe, a quarter or 2 quarters out is possibly another death cross. So that is very likely. Now, do pay attention to this prior price action. So the day prior, we had a strong bounce off of the 50-day moving average. But then look what happened this morning. So, this morning when we got that PCE report, we faded pretty hard. We almost tried to test that 200-day moving average. So today's candle is pretty much touched the 200-day and the 50-day. So almost did a touch of both. And we're closing in between. So it's very possible that in the future, near future, I'm talking like next week, we could just be trading within this range right here. So that range will be around 393.12. And the 50-day moving average, which is right at 396.86. Obviously, if we want to be a little bit more bullish, we want to stay above this 50-day moving average. So a close above that would be welcome for the bulls. And if you're a bear, you want to see constant closes below this 50-day moving average. And ideally, if you're a bear, you want to see a close below this 200-day moving average. That would probably be a bull feeding frenzy. Now, moving on. We're looking at the XLF, which is the financial sector. So this sector is actually still pretty strong. So you guys can see the last few days were pretty interesting because we pretty much fell off a cliff here, and then you can see that we tried bouncing off the 50-day several times. So this orange line is the 50-day. It's at 35.45. You can see right here we bounced off it. Right there we bounced off it. Right there we bounced off it. But do notice that we have these wicks. So there are some sellers showing up here. Now also notice that today we tried breaking below it again, but then we bounced above, and we ended up closing above this 50-day moving average. Now, one thing I do want to talk about is in the XLF, JP Morgan is a huge weighting. And JPM actually got a positive analyst price target, an upside price target today. So that is probably what is contributing to XLF being up today. And do note that it's up small, so it's not up by a big amount by any means. But we are still above the 50. Now, let's go ahead. Let's look at the next ticker. So we're looking at QQQ. So that is NASDAQ. That's following the NASDAQ. NASDAQ is still looking okay, but we are seeing signs of weakness. So, over in the S&P 500, we lost the 50-day, but on the NASDAQ, we're still above this 200-day right here. So, obviously, if we crack below this 200-day, that could spell more trouble for the markets. That 200-day is sitting at 290.12. We closed at 291.85. So, we do have a little bit of margin of safety here. But obviously, if we fall in between, we could be trading within a range of 285.35 and 290.12. We could honestly just chop between these two moving averages before we want to make this decision. Hey, do we get back above the 200 or do we fall below the 50-day? So, a very potential situation that could happen is we could just end up chopping around here for quite a while, and maybe we have like 1 day close fake outs or whatever, but that is a very likely scenario that could play out in the future. But obviously if we break below that 50, things get much more bearish. Now looking at XLE, which is the energy sector, this is pretty interesting right here. So as we can see, we have this 50-day moving average. We broke below that. But then look how we broke below that. I mean, we had a gap below it. So if we were to fill this gap, we could get back up to the 50-day moving average. But do note that we're wedged in between here. So we're already seeing the similar situation on XLE and S&P 500. So it's very possible that QQQ can join it, and we could go right in between this moving average sandwich. So yeah, that's where we're at right now. We have this 200-day moving average at 82.65. We have this 50-day moving average at 87.43, and we're pretty much wedged in between it. Look at these last few candles too. So there's a lot of indecision here. So we can see a lot of dojis. Let's go ahead. Let's move on. Let's look at the VIX. So last time when I talked about the VIX, I pointed out this gap right here, which we got in 2020. And essentially when we got this gap, it was just this huge rally on the VIX, and that's when we had that pandemic crash. So, this gap is pretty significant. Obviously, if we get below the bottom of this gap zone, which is 1841, things look short-term bullish. But then if we get above this gap area, which is 2202, things start looking bearish. So we did get above that momentarily. So I'm going to zoom in right here. So we did get above that momentarily, and we saw the stock market sell off pretty big. But look at how the VIX closed today. So we closed back underneath that 22. So this is going to be an interesting development. We want to watch the VIX very closely, because obviously if it gets back above 22, things start looking bearish. And, the stock market starts seeing some pressure and some crazy swings. But as of right now, we have this shooting star type candle. And generally candles like this lead to further downside, but we'll see about that. Obviously, right now there's a lot of crazy stuff going on right now. We saw all these inflation reports, and really the next big catalyst is probably going to come with the next non-farm payroll. So next month is probably when we're going to see a lot of new data drop. And obviously, if things start looking a little bit better for the inflation front and we start seeing a little bit more deflation, well then the whole rate situation starts looking a little bit better. So that is probably one thing that the bulls may have in their favor if obviously inflation doesn't prove to be as sticky in the next report. So that's what I'm seeing for the VIX. One thing that I noticed that was extraordinarily bearish today was looking at that Fed funds future spread. So, I've talked about this before, and if you're not very familiar, let me explain this again. So we're looking at two different contracts, and we're looking at the spread between that. So ZQH23, that represents the March Fed funds futures. ZQZ23 represents the December Fed funds futures. Now, if I'm taking the difference between that, I'm getting the spread. So essentially what this reading right here, this 0.65 reading right here, it's saying that the December contracts are expecting a Fed funds futures rate of 0.65 higher than that of March. So let me just explain this a little bit better. So we're going to go right here. We're going to look at the CME Fed Watch tool. Now right here, it says the current target rate is 4.5 to 4.75. Now if we're looking at March, it's highly expected that we're going to see this Fed funds rate go up to 4.75 to 5%. So, if right here, we're looking at this future spread, it's saying 0.65. So what that is essentially saying is that it's pretty much saying 0.75. So 0.65 is closer to 0.75 than it is to 0.5. So that is essentially saying, hey, in December, we're expecting the Fed funds futures to be 0.75 higher than in March. So what does that mean? That means that we could potentially see a Fed funds rate in December that goes as high as 5.5 to 5.75. Now, I want to show you something interesting, and that pretty much happened after today's PCE drop. So let's go ahead and look at what the CME Fed Watch tool is expecting for December. So right here, we see the probabilities. It's highly probable that it's 5.25 to 5.5, but we also see that it's also probable for 5.5 to 5.75. Now, look what happened here now. So this now versus 1 day ago. So 1 day ago, when we were looking at this 5.5 to 5.75 range, we were expecting a 12.4% chance of this happening. That jumped after this PCE report to 20.6%. And this 5.25 to 5.5, we went from 32.5 to 38.3%. This 5 to 5.25, this went from 34.6% yesterday to 27.9%. So now we're seeing probabilities increase of a higher Fed funds rate. So it seems a little bit more probable that now, we could be in this 5.25 to 5.5. And what wasn't as probable was seeing a Fed's funds rate as high as 5.75. Now we're seeing that this is becoming a little bit more probable, 20.6%. And like I showed you in the Fed funds futures, this is 0.65. If it leans closer to 0.75, we are going to see those probabilities increase. So if you don't have this chart, you want to have this chart down, and you want to see it after data drops like this, after the PCE, after the CPI, after all these different inflation reports, because this is what is going to move these probabilities. Now, one last thing that I want to talk about, I want to look at DXY, because obviously that went up pretty big too. Now let's see, DXY US dollar right there. Let's go ahead and zoom out. We are going to look at the 10-year 1 day, and I'm going to move this over a little bit. So I want to basically highlight this area right here. So let me just zoom in a little bit more here. All right, so here's what I am looking at. So right here, we have this yellow range, and this range is a range of consolidation. So we can see a lot of consolidation. This ended up being distribution. We can see that this fell right here, but right here, when this was consolidation, it ended up being accumulation. So here we see accumulation, here we see distribution. What are we seeing here? Is this accumulation? Because that is very possible. Maybe we see another move like this. So one thing that I am watching is that once we break out of this little range right here, we tend to try and tap this area right here. So this 105.71 price level. So this is an important level to watch, because you can see that we tried breaking out before. So right here, we tried breaking out, but we rejected very hard. And you can see that is what caused this downfall right there. So what's going to happen now? Are we going to try and test that again? Maybe we test that, we reject, and then we break out. So it would make a lot of sense for this to go up higher, but let's think about another scenario. Let's say that the Fed just raises 0.25, maybe they say some more dovish things, and maybe the ECB and the BOE, maybe they're a lot more hawkish and they start raising like 0.5, 0.75. That could cause the dollar to fall. Because remember, the dollar is in relation to other currencies. So obviously, bottom line, if we go above this 105.71 and we sustain this level, then you could probably see equities sell off. Because remember what a stronger dollar does to these multinational companies. It hurts their revenues because they have to denominate those foreign currencies back into United States dollars. And if it's an unfavorable exchange rate, that hurts their revenues. So that basically summarizes everything that I wanted to talk about today. And I hope you guys enjoyed this video.